Back with markets at noon, and so much to talk about in terms of what's happening on the regulatory front. We've got new norms coming in for the capital market norms from the RBI. Let's take a look at what these norms are. And to try and understand a little bit more, banks are barred from funding capital market intermediaries, that's CMIs, for proprietary trading or acquisition of securities. And from the 1st of July, which is today, bank guarantees used in capital markets must be fully backed by collateral, a move expected to reduce leverage and raise funding costs. Of course, this is only the upper layer of what the new norms are. We'll dive deeper into all of these. We've got some experts on the show joining us to try and make sense of what these new norms are, and more importantly, how they're going to be affecting banking, the financial services space, and the overall market. We've got Mr. Sandeep Parekh, the managing partner at FinSec Law Advisors, joining us on the show, and joining him is Mr. Ashwin Parekh, managing partner at Ashwin Parekh Advisory Services, on the show. Gentlemen, good afternoon, and thank you so much for your time. Mr. Ashwin, let's begin with you. If you can help us understand what's the RBI's broader objective behind these tighter norms, if this is primarily about reducing systemic risks, or are there other concerns the regulator is trying to address?
No, I mean, it starts with systemic risk, as you rightly said. And then this is not new. I mean, in the sense the draft was actually initially put out in February itself, saying that it would be effective from 1st of April. Then the banks went back to the Reserve Bank of India and requested, to take a fresh look at it. And then it was agreed that it would be implemented from 1st of July, which is like from today onwards. So, I mean, it's not new. Two things, two underlying sort of, regulatory kind of implications. One, of course, is you will realize that all along, RBI has always considered the banking kind of asset exposure, loan exposure, in the areas of real estate and in the areas of markets, security markets, as like speculative. And therefore, they've always been watchful from the systemic risk point of view and from the stability point of view, the financial stability point of view. They've been watchful on the size of these portfolios in the banking system. So, I mean, that's the backdrop. I mean, even the draft that was put out earlier very clearly mentioned that it would like to restrict the bank's exposure to security markets, kind of, both used as collateral as well as the funding of that. So there are limits now prescribed, on these. That's the underlying sort of principle, or the underlying reason why the RBI is doing this. And time and again, we've seen in the past also that RBI has been very watchful about the banking system's exposure to these two kind of assets, basically.
All right, that's the view coming in. Mr. Sandeep Parekh, let me come to you then. Which participants do you believe are likely to be impacted the most as a result of this regulatory change? Could it be brokers? Could it be market makers, clearing members, or wealth managers per se? Your sense and your understanding of the regulatory change that we are seeing from today? Mr. Parekh, please unmute your mic. Yeah.
I'm unmuted. Can you hear me?
Yes, we can hear you. Go ahead.
Okay. So before I answer your question, let me also mention something else which RBI has done, which is, I think it's also loosened certain norms, including acquisition finance, including leverage, which may be given to individuals, investors. The ceiling has been raised from 20 lakhs to 1 crore. So they've done multiple things to kind of ease lending to individuals and for acquisition finance. But at the same time, I think they think that there is some risk which is building up in the system. And therefore, what they've done is really not reducing liquidity. They're attacking leverage. They don't want too much leverage. And again, essentially, it will hurt, I guess, 2-3 kinds of people. One is going to be the brokers, proprietary brokers who borrow money. Secondly, I think there's kind of more, not just the limits, but there have also been other norms which have been introduced to tighten how the calculation is done. And thirdly, the haircut has been reduced, which means people can lend less money compared to the securities which is more offered. So broadly, the market itself, clearing corporation will have to have, it will be impacted because it will have to post better margin. Leveraged brokers, both for proprietary and other, will be impacted. And on the margin, I would think even wealth managers would be impacted. But like I said, I don't think it's the idea is to reduce leverage, not to reduce liquidity. And hopefully, I think the markets will absorb it. there will be, I would call it disruption, but there will be an impact in the short term. But I think over a longer period of time, this will be just kind of be a much safer system as such. So I would not be very worried about the consequences.
Okay, understood. Not very worried about the consequences. Mr. Ashwin, taking the conversation ahead, the new rules also restrict the use of third-party collateral. How significant a change is this from current market practice, and what operational challenges do you foresee?
Yeah, so see, basically, if you look at the banking data and if you look at the collateral data, I mean, you will certainly find that there is a presence of, particularly in the prop trading, a certain amount of third-party kind of assets which are offered as collateral, and on the basis of it, the leveraging is carried out. So I mean, I would certainly say that, look, the norms clarify very clearly that the third-party kind of asset collateral will not be accepted by the banks. So, I mean, to that extent, there would be an impact. We don't have the numbers at this point in time, but I suppose if we go back and look at the representation made by the banking companies, let's say for the April implementation, earlier implementation, and then that was pushed to 1st July, we'll get some answers there saying that, look, even the third-party asset as collateral, I mean, the numbers that the banking system would have submitted, RBI would have taken a view on that and then thereafter implemented that sort of, so that's one. To my mind, I suppose, compared to April kind of an implementation, I mean, July implementation is a much better time, particularly in keeping with what the RBI's objective is. If the RBI's objective was that, let's say, the market should not unnecessarily get heated up on account of leveraging that is carried out by the brokers, then in that case, perhaps July is a much better time compared to, because we have started seeing now that, I mean, July now and some part of August also, the market may remain a little sort of, optimistic about various outcomes. And also to that extent, I would say the timing is really very good compared to April implementation, sort of.
Understood. Mr. Sandeep Parekh, let me come back to you. And for retail investors, the Reserve Bank of India has also raised the IPO financing limit but capped the loan to value ratio at 75%. On balance, is this a net positive, or does the higher margin requirement offset this kind of benefit that these investors will enjoy?
No, so, I think it will impact different people differently. I think it will impact MIIs, it will impact prop trading brokers, it will impact some of the lending which brokers are doing today. I think overall it will increase the limits which are available for IPO funding, for the kind of collateral benefits that you get as an investor. So it will, I think, overall, I think it will suck up some of the leverage in the system. But at the same time, some people will benefit. And like I said in the beginning, acquisition finance has separately been liberalized. So it will certainly benefit certain classes of people, investors, and transactions, and certainly disadvantage certain other classes of investors.
And that makes a lot of sense. Lastly, Mr. Ashwin, quickly, if you can give us your perspective that from a regulatory perspective, do these changes bring India's framework closer to global best practices for financing capital market activities?
No such thing as global best practice. Each market has its own sort of dynamic environment and all. And I mean, we must say that as far as the regulator, I mean, the RBI is concerned, he's actually kept very close with the industry. I mean, look, we know that, let's say, when banking system made a plea to the regulator to extend the deadline, I mean, the implementation date, he did it. So I suppose it's each jurisdiction will have its own play between the banking system and its regulator. But I would certainly say one thing. I think the pulse of banking that the RBI observes, on a very dynamic, on a real-time basis, is amazing, quite honestly. All aspects, because it has a much larger role also in the economy. And I mean, I would certainly say that these norms, these guidelines, when they brought in, I mean, there's a huge amount of study that goes between the banking system and the regulator before these are implemented, sort of.
Okay, understood, and really appreciate you taking the time out, Mr. Ashwin Parekh as well as Mr. Sandeep Parekh. Thank you so much for your time today. Viewers, with that, I'm afraid we're completely timed out on this edition of Markets at Noon. Thanks so much for tuning in. But keep watching ET Now, because All About Your Company throws the spotlight on Standard Engineering today.